Right, Pranay, thanks for that. Also, let's welcome in Amit Nigam, Head of Equities at Peerless Funds Management. Afternoon, Amit. Thank you for joining us on Lunch Money. Just your reading of the market situation. There are moments when market seems to get excited, head towards 8,900, and then fail to hold those levels, and you see some kind of a consolidation over the last month, broadly trading between that 8,900 to 8,700 range. What's your view of market direction going forward, and what are some of the key triggers that we should be watching out for?
Hi, good afternoon. I think the biggest thing at these levels happens just to keep eye of what has already happened and what has resulted in us being here. So if you see post-budget, somewhere around in the month of February, we have done a smart move up about 30% from the lows. And at current junction, we are looking at valuations which are roughly one standard deviation higher than our 10-year average. Now, this rally happened at the back of two things. One was the fact that the earnings in our domestic markets were improving. So fourth quarter last year was much better than the expectations, and somewhere those expectations were being extrapolated for the year to come. Now on that front, this quarter has been somewhat disappointing, wherein we have reported for at least the Nifty large companies, the Nifty 50 earnings growth of about minus 3.5%, which means we have actually seen an earnings decline. With that, what has happened that the expectation of the positive momentum on the earnings growth to continue has somewhat taken a back seat. Now, the other reason for this rally has been the global liquidity, which has essentially been spurred by the fact that in a lot of our developed markets like Japan, Germany and Switzerland, we are seeing negative interest rates. And that in a sense has been fueling equity rally across the markets, and in fact not only in equity but many other asset classes, because today the cost of funds has become so much cheaper. Now, the liquidity is something which is extremely difficult for anybody to extrapolate, and therefore from that perspective it will be difficult for us to predict as to going ahead where it's gonna head. However, the interest rates are not going to turn positive in a hurry. Therefore, we may assume that as a base case, this liquidity is going to stay here. Also, with the recent Fed meeting, we realized that they are not in a hurry to increase interest rates, and that supports that argument. Now, the other thing, which is what we fundamental analysts tend to focus on, is the fact that earnings have still not shown a substantial movement on the positive side when I look at the large cap companies. However, the same on the smaller companies seems to be in a better trajectory, and therefore we are seeing a sharp divide in the performance of the markets, where we are seeing the large caps being pretty much lackluster after having done the initial move, but the mid caps have continued to do much better.
Right. Of course, talking about financials in this space has been doing well of late, was one of the key drivers of the recent market rally as well. Just your call on the PSU versus private bank divide, considering that PSUs may be the worst, maybe over as far as asset quality concerns are concerned, and they are sitting on significant treasury gains as well. So what happens to them going forward from here?
Yeah. So, see, structurally we have been more positively aligned to the private sector banks, given the fact that, forget the last 2-3 years, but if you see the last 25 years, that the private sector banks started gaining inroads into this space. So 25 years ago, there was no private sector bank. Public sector banks had 100% control of the business. Today, the private sector banks have gained 25% market share, and they have done it by not compromising on profits. In fact, they make much healthier profits than the public sector banks. Now, in the past, especially in the last 4-5 years, we have seen the public sector banks growth taking a huge backseat because of the asset quality pressures which they faced, which had basically two reasons. One, the economy slowing down and not doing as well as they had initially thought of, and the fact that the initial slowdown forced a lot of corporates, which though they wanted to put on large projects, their ability to service these debts has been extremely difficult, which resulted in the NPAs becoming a large proportion of the loans which these banks gave out. Now, in the last 12 months, we have seen a lot of initiatives which both the government and the RBI has taken, as a result of which we have seen the banks take a huge correction on their on the asset side, and thus letting the investors get a fair picture of the kind of book that they hold. But we are of the view that the problem is still far from over, and it will still take some time for the public sector banks to come back and start growing their business as aggressively as the private sector banks anytime soon. So therefore we continue our stance of being more favorably aligned towards the private sector banks.
What about the IT space, Amit, with the kind of commentary that you've had from the larger as well as mid-cap players? Do you feel that the fear is warranted, and do you see that possibly there may be fund outflow from some of the tech majors, or is the commentary overdone for now and there is still a value case to remain invested in IT over the long term?
Sure. See, again, the IT space, the way we look at it, we first of all tend to look at the bigger picture of the sector as to what has happened over the last 10-15 years. So if you see about 15-20 years ago, this was a very small space growing at very high double-digit growth rates. So let's say the leaders in the industry would grow at 70, 80, 90% per annum in terms of their top line. They had very high return on capital employed, upwards of 50, 60%. But over the years, these companies have become really large companies, and the kind of growth rates which they had exhibited many years ago, it becomes extremely difficult for them to replicate the same. So today, if you analyze, these companies are growing either very high single digits or low double digit growth rates in terms of revenues. In terms of return on capital employed, a key parameter that we at Peerless focus on while we are selecting or identifying stocks, this number has come down over these last 5 to 10 years. So though they are still very healthy and much higher than the cost of capital that these companies enjoy, but having said that, this number has declined, and therefore to us this industry from a historical perspective becomes slightly or let's take it takes a back seat because it is growing at a slower pace, and it is deteriorating in terms of return on capital employed. And when I look at future, I see that the challenges for growing this business still exist as people move on to more automated stuff, and with the kind of changes which are happening in the developed markets, for example, the Brexit, wherein the business will get reallocated, reorganized. The only, let's say, the silver spoon here is the fact that the valuations have corrected significantly, and for the kind of cash flow generation which the industry enjoys, these valuations are definitely much more better for an investor to take an active look at.
Right, Amit. So then leave us with a strategy on the market. So where would you advise investors to place their bets on with your reading of the market environment currently, and possibly some sectors to stay away from?
Sure. So we actually do not focus too much on sectors. We focus a lot on the companies, and we have a philosophy of investing in those companies where the business model ensures that over time, and when I say over time, I'm actually looking at 3 to 5 years, where investors can actually create wealth. And for that, the business should have a model wherein the pricing power exists with the company, and they are run by people or management who are capable to grow their business much better than the industry, and also in that process they take care of the minority shareholders. If the companies follow these 3 big pillars, then we believe that the investors over longer term can make good returns. And being invested in Indian equity markets, where we have such a large consuming population of more than 125 crore people, We are, and the people have just started earning. We have just crossed the key number of $2,000 per capita of income, and that's where the discretionary spend of consumers takes off. And this we have seen across market times, across different economies. So with strong fundamentals in place, we are extremely positive about the companies which fit our criteria of having good business model and having strong set of promoters to do extremely well in the years to come. And we would urge our investors to try and focus on such companies rather than just following markets.
Right, Amit, we'll leave it at that, but appreciate you joining us on Lunch Money today and taking us through your strategy on the markets. That's the market view coming in from there, from Peerless. Let's also focus in on the stock of L&T. You have positive commentary coming in on this one. Credit Suisse reiterating its bullish stance and has raised the target on the stock. Piyush has been going through that report. Piyush, what's driving the optimism for Credit Suisse as far as L&T is concerned?